Hello, Eric Walczykowski here, CEO of Bespoke Partners and host of Tailored Talent, joined today by our Chief Commercial Officer, Adam Boone. Boone, welcome to the show.
Thanks, Eric. As always, awesome to talk to you about the trends we're seeing in talent.
No doubt. Well, hey, look, I mean, it was a long, hot summer as we expected. I think the first half of the year definitely saw significant choppiness in the market. Of course, Bespoke Partners has done a great job continuing to place executives for the best, very best private equity company portfolio companies back to school. And here we are, we're off to the races. How are you feeling about the market?
Yeah, well, a lot of people are saying, here we come, the floodgates are opening, we're so back. And that's because this rate cut that everybody's been so hotly anticipating has finally taken place. In fact, as you know, Eric, today we have released the latest market update edition of our very popular private equity talent report, which focuses in on the software and SaaS sector. Anybody, you can request your copy by scanning the QR code you see on the screen, or clicking on the link in the comments of this event, or visiting our website. And in this report, we're detailing the state of the executive talent market in this rapidly changing environment. I think what we're going to see here, and we're already seeing the signs of it, is all three exit avenues are going to reopen for private equity. We're going to see a lot more of the IPOs. We already had a pretty good IPO head of steam in the first half of the year. I expect we'll see that continue even more. We see sponsor-to-sponsor deals that are picking up even more. But then the purchases by strategics, leverage buyouts, all these avenues of exits are going to open up even further, and the floodgates are going to open. That's going to get the natural deal cycle going again, right? More liquidity to plow back into more deals, and I think we're really going to see the market take off.
No doubt. And I spent the month of August visiting with a number of our key private equity clients, and the theme is deal pipelines are full. Not only are they full, but they're full with high quality assets, and they're seeing a path to getting a deal done. Additionally, I caught up with a number of investment bankers. They're busier than they've been in the last several years with several new mandates. And so I think what you're talking about the floodgates opening are quite significant. And I think we're headed for a good 12 to 24 month bull run as you start to think about private equity deals, M&A transactions, public offerings. And so this long anticipated buildup, I think we're actually going to start to see.
I totally agree with that. One of the big gating factors here, really the bottleneck, had been around the exit freeze that we've been seeing for the last couple of years. And we saw that continue through, much of the first part of the year. Well, that's really started to ease back up. If you look at sort of the three broad categories of sponsor to sponsor, selling to strategics, or going IPO, all three of those are now starting to open back up. And I think that optionality really makes, PE in general a lot more optimistic about what they can do with these assets. They can unload those assets, they can get liquidity, and they can start the cycle over again of fundraising and getting into more deal flow.
Now, that said, all this excitement, all the euphoria around these full pipelines, we do have a significant backlog in terms of assets that need to exit. And boy, that really exacerbates this tight talent market that we always see, because you have a number of executives that are getting close to the altar and they actually want to go through and make the transaction happen. What do you anticipate seeing in the talent market in the next 6 to 12 months?
Yeah, it's going to be really counterintuitive. And that's because we're coming out of a period that was very counterintuitive. Traditionally, in our space, in private equity-backed portfolio companies, talent is tighter when deal flow is higher, right? You're investing in new assets, you're buying new platforms. One of the chief levers of value creation is hiring new talent in, new leadership that can take the company to the next level and has the playbook to execute on value creation and all these good things. Well, that makes the talent market much tighter, and it drives up comp packages and scarcity of the supply on the talent side. Well, what we saw over the last year and a half, 2 years, is that because exits were delayed, you were not getting that natural churn in the market that takes place as executives bring their company to exit and then are ready to take on their next assignment, right? That just wasn't happening. People were staying put. They were driving through to the exit. They were really focused on getting the asset exited, and so they were not leaving. They were not as open, perhaps, to taking on new assignments. And so as we detail in the new edition of our talent report, executive turnover is significantly down across the board, with the exception of a slight uptick in CEOs. But otherwise, every functional role is seeing the lowest executive turnover level in years. You would think that now with deal flow picking back up, that in fact that would loosen up. But there is such a backlog in exits that I anticipate we're going to be looking at a very tight market for a while longer here. PitchBook reported that portfolio holdings in the United States counted almost 12,500 portfolio companies. And that is an all-time record in the first half of the year. And that means that, there's this huge bloat and a lot of exits to work through before we start getting to the sort of natural talent cycle that we tend to see in the market.
No doubt. Well, let's take that challenge head on, and let's start first with, we have these number of companies that need to exit. So if we think about what do these companies need as they approach exit, what should they be doing to evaluate their teams, and what roles might be in demand?
Yeah, absolutely. I mean, there are a couple key things that you really need to be thinking about in terms of talent that will position the company for exit. One of them that's very commonly examined and is under the microscope when it comes to exits is, of course, the CFO. And the need to have a CFO who understands how to execute on the M&A and inorganic growth aspects of value creation, right? If part of your strategy is to do a roll-up and get some add-ons and really sort of take your platform and raise it to a new level through that methodology, well, you need a CFO who gets that and really knows how to drive that. Another one that we see just a ton of activity around is the go-to-market leaders. So your CRO, your CMO, your chief customer success officer, depending on your overall revenue model and your business model, one or the other of those is going to be really mission critical to getting you to exit. And that, of course, is all about the growth, right? Figuring out ways that you're going to be able to grow and drive either that organic growth or, if you're in a recurring revenue model, get the customer retention that you need to maintain your growth path. And then the third real area that we see a lot of interest in is in the chief product officers. So these are the people who are responsible for thinking through how you're going to grow, perhaps by entering new market segments or tapping unmet needs within your existing client base, right? And so they're thinking through how you grow in that fashion. These are all strategic intents, right? These are all strategic goals, but all of them add up to making the asset much more attractive for exit in the long run.
No doubt. Well, and look, I mean, as a CEO who's taken a number of companies through this exit, one of the things I like to do in that 6 months leading up to the exit is really start thinking about the next phase of growth or the next hold period. And I think you hit the nail on the head as you start to think about strategy. I'm looking at the next 4 to 5 years. Do I have the financial leader that's going to take me on that journey? Do I have the go-to-market leadership that's going to propel that growth that the next owner is going to want to see? And is my product market fit? Does the basket of products I have going to fit the needs or demands of the market in the next 5 years? And so I think addressing all of that and kind of thinking through who the buyers are and what the next hold period looks like is really going to lead to this outsized value in the transaction we're hoping to get in the next 6 months.
Yes. And our new talent report includes a fascinating deep dive on team composition at scale. Now, this is something that we are often asked about by sponsors. At what company stage do I need a seasoned C-suite leader in this given function? And specific to the chief product officer trend, we see this really interesting change in earlier stage companies taking place. So that is companies with revenues below $50 million a year. The number of those firms having a chief product officer in seats has doubled in the last 2 years. And this really tells you something about how critical those chief product officers are for the next stage of growth.
Well, look, I mean, we kind of hit the nail on the head around what's going to be important as you go to exit. Let's go to the other side of the equation now and say, wow, a bunch of new platforms are being launched. What kind of needs are we anticipating there?
Yeah. Some fascinating stuff going on there. So in the first half of the year, particularly late in the first half of the year and into third quarter here, we saw a bunch of really interesting take private deals taking place. Take privates, of course, are always a popular part of the PE playbook. But we saw, for example, Thoma Bravo announcing they were taking Dayforce private, and a bunch of others of that sort. And there's always some really interesting talent considerations when you're doing that. One of them is Bain put out an interesting benchmark not long ago where they indicated that the CFO of a take private company should be prepared to achieve 15 to 20% cost optimization in the first 18 months. So that tells you some really interesting things about, number one, the profile of the typical public company, and then the profile of what's expected of the portfolio company, the new platform that a private equity company has taken private and is now looking to grow through value creation. Optimization and driving cost out of the business is a chief part of that equation. So you need a CFO who's really adept at cost optimization and driving out cost.
No doubt. So, I mean, I think theory number one on take private is this optimization. Public companies, divisions of public companies tend to run a little less efficient than I think what private equity firms see in their playbook. And so 15% cost optimization is number one, which I think really hits to the financial suite and finding that CFO that knows how to drive a capital efficient play for private equity. What else do you see in the take privates, Boone?
Yeah, take privates just in general. The cadence and the sequence of your activity and your horizon within a take private is different from a public company, right? Public companies report quarterly. The horizons tend to be, of course, they look at the annual plan, but they're also very, very focused on performance quarter to quarter because that's what the market cares a great deal about. When you have a take private situation and now you're a private company, those horizons can change and the value creation plan can change. And you can be willing to invest for a longer term growth strategy if that's what's needed to really raise the asset to a new level. And so you need your go-to-market leaders, you need your product leaders, you need obviously a CEO who is who has those things in mind and are aligned with the value creation plan that the sponsor has for the new take private.
No doubt. Well, and look, I mean, I think the notion of a take private, yes, you have a longer time horizon potentially that you're looking for in terms of investment. You're not being evaluated by the street daily or quarterly as they report earnings.
Right.
That said, what I've seen in the private equity deals, right, you've got a defined timeline. You're looking at a 4 to 5 year hold period. And my experience working directly with these private equity sponsors is the rhythm or the cadence actually picks up. And so while you don't have all eyes on you from the public standpoint, you're working very closely with that private equity firm. You're reporting numbers monthly and you're being evaluated monthly as to the pace that you're taking this asset to the next level and executing on that value creation plan.
Yes, the change in scrutiny and the change in reporting does not mean velocity changes or slows. It actually means the opposite. Your velocity and your growth planning and everything you should do around execution actually increases. So yes, 100% agreed on that. And I'll also note that what that means is search velocity needs to increase. Search velocity becomes a competitive advantage because you are competing for the best talent when you are in that sort of situation.
No doubt. Well, and look, I mean, I think this really speaks to one of the number one criteria on our scorecards is private equity experience in every search that we do for a private equity firm. And I think we just hit on the reason why, which is, are you used to the pace, the level of scrutiny, the agility that a private equity firm demands as they're expecting you to execute?
Exactly, Eric. And in our next episode, let's dive into how you identify and execute on landing that talent in a super tight market. Thanks a lot and talk again soon. So long.